Hi, my name is Colleen Anderson, and I'm a financial advisor with the Capital Group based in Madison, Wisconsin. We actually have some good news this week on the world stage. After nearly 4 months of conflict that rattled the global economy, the US and Iran have finally announced a preliminary peace agreement, which includes a 60-day ceasefire, the reopening of the Strait of Hormuz, and a framework for continued talks. The markets noticed immediately. Stock prices moved higher, oil prices dropped, and interest rates are starting to edge lower. Not a bad day. So now, before anyone pops the champagne, this is an early stage deal. There are a lot of unanswered questions still. And a 60-day ceasefire is not the same thing as a solved problem, but it is a meaningful step, and it has real implications for energy prices, financial markets, and your portfolio. Geopolitical events have a way of feeling enormous in the moment, and sometimes they are. Sometimes the market shrugs them off faster than the news cycle does. But over the next few minutes, we're going to sort through what actually matters here and what you should be thinking about as an investor. Let's get into it. Let's start with the one thing that this conflict has hit the hardest: your wallet at the gas pump. At its worst point in April, oil hit around $118 per barrel. Why? Because the Strait of Hormuz, which is a narrow waterway that a huge portion of the world's oil passes through, was disrupted. Think of it as a garden hose. When you step on it, everything else downstream just slows down. The good news is that oil prices are already started to fall before this deal was even announced, dropping more than 25% down to about $85 per barrel. And gas prices followed, climbing. It was up to about $4.50 per gallon, but now it's edging back towards $4 per gallon. Still not fun, but heading in the right direction. Now, overall, inflation is at its highest point in 3 years. And it does sound alarming, but here's the thing. When you strip out food and energy costs, core inflation came down to just 2.9%. And that does tell us something important. The higher oil prices have not yet spread too widely through the rest of the economy. The damage has mostly been contained to energy. And history gives us a good reason for optimism here. When oil prices spike because of a supply disruption and not because of fundamental change in the economy, they tend to come back once that disruption is resolved. So a reopened Strait of Hormuz would be a very big step towards exactly that. Here's a chart that may actually surprise you. Despite everything that's happened this year, the stock market is actually up. The S&P 500 is ahead roughly 10% so far this year. Not a bad year that included geopolitical conflict, an oil spike, and inflation hitting a 3-year high. I keep getting questions about how can this be? How can the stock market be doing so well? How can it be gaining when there's so much going on in the world? And the answer is really that the economy has stayed solid and company earnings have really held up well. And this isn't just a one-trick pony. 8 out of 11 sectors of the S&P 500 are in positive territory. Energy is leading the way. No surprise there given the high oil prices, but tech has done really well too. And even the quieter, more boring sectors like utilities and consumer staples have chipped in. Boring, by the way, is sometimes exactly what you want in a portfolio. International stocks, too, have continued to perform well, building on a couple of solid years. On the bond side of things, it's looking relatively calm. The 10-year Treasury yield is sitting below 4.5%, and the 30-year is just under 5%. Lower rates reflect something important: improving expectations around inflation. The bond market is essentially saying that it believes that this situation is getting better. So here's the thing. The broad performance across so many different areas of the market is exactly why diversification exists. You've heard me say this before. Diversification is not a buzzword. It's what's keeping your portfolio standing when one corner of the market hits a rough patch. A well-balanced portfolio is not exciting, but neither is watching everything drop at once. Okay, I really like this chart because this is where perspective really matters. Over the past century, markets have lived through world wars, oil embargoes, regional conflicts, financial crises, and just about every other kind of chaos you can imagine. And in nearly every case, the same thing happened: short-term turbulence, long-term recovery, new highs. What drove that long-term growth was not the absence of problems. It was the underlying strength of the economy and the resilience of businesses that kept adapting and moving forward. Problems came and went, and the markets kept climbing. This situation is not different. Every time we're in the chaos and in the thick of it, we think this time is different. It's not like the other situations in the past, but we have to look at history and say, it's really not different. Now, going back to our current situation with Iran, we know that there have been temporary ceasefires and failed negotiations during this conflict before. The deal that's on the table now is encouraging, but it's on paper, it's only 60 days old. Patience is a virtue here. It's a strategy. A long-term resolution would be genuinely wonderful news, and not just for your portfolio. Real people have been affected by this conflict, and that is really what matters most. The bottom line here is that the outcome of these negotiations does not change what good investing looks like. Stay invested, keep a balanced portfolio, and don't let the headlines make your financial decisions for you. The news cycle moves fast, and good financial plans do not have to. If anything I covered today raises questions about your own situation, I'd love to talk it through with you. Feel free to reach out. Thank you.